what is your outlook for the global economy, and how will that influence global fund flows, I suppose?
So let me take the first part of your question a little bit separately, which is that the last couple of years have been really predominated by some very large idiosyncratic risks, and whether it was the global pandemic, two wars that people didn't really see coming, rather than by the traditional business cycle. And that's led a lot of people to say, wow, are geopolitics and other things becoming a bigger risk than they have been before? And our answer to that is that actually not. They're going back to normal. And that it's actually been the last 15 years, which has been remarkably stable, that are the aberration. But if we go back, really to the times since the Second World War, we would see that these kinds of shifts and changes and alliances and, unfortunately, regional skirmishes are actually pretty much the norm. So we would say we're going back to a world where we will have more idiosyncratic risk, but that is what we get paid to do. That is part of the risk premium that we get paid to do. So we need to construct portfolios that account for this kind of risk. And in general, those portfolios are going to look a little bit different. They're going to have a little bit more privates to them, but they are also going to have more liquidity in them, because you need liquidity to be able to move when some of these events happen. And that's very different from the thinking that kind of the biggest risk was the business cycle. And we would have, a big argument about, well, are we going to have a recession or not a recession? I actually get that question much less now than I do about how do you see the U.S.-China, relationship playing out and what's happening to global supply chains. So those are, I think, the biggest risks that people are focused on. To your question around growth, the answer is that it's highly divergent. Being here in the UK and on the continent some over the last 10 days, growth is actually pretty hard to come by. The EU overall isn't any larger today than it was in 2018. On the other hand, last month I was in Japan, and you've never seen such a bouncy group of people. Inflation is finally back, growth is back, the stock market's hit an all-time high, and probably Japan has been the biggest beneficiary of the tension between the U.S. and China. You see a lot of the emerging markets where the supply chains are actually growing, whether that's Indonesia, Vietnam, Mexico, doing pretty well. China, really struggling. Yes, the official growth rate is 5%, but there's really no international capital at this point that's going into China. And then you come to the U.S., where a year ago people were saying, well, maybe there'll be a recession, and will we have a soft landing? And here we find ourselves better than a soft landing. We actually have growth has been reasonably robust. The labor market's in very good shape. Inflation remains a little bit stubbornly high, but overall, actually, the markets and the economy are in good shape. So the net of that is that I would say money is being reallocated away from Europe. It's going into Japan and into these other emerging markets, which are beneficiaries of the supply chain. It's going into the US, and it's not going into China at this point. So you are seeing a real reallocation of global flows than if you'd asked me that just a couple of years ago.
Yeah, that's really interesting. How do you respond to that as an asset manager? Is it simply about having a strategy, having a really broad waterfront strategy sort of geographically, and sort of encouraging those geographic allocations where they might not have been before, because we're used to a world of EM, global.
It is. I mean, we really don't like the emerging markets nomenclature at all. I mean, it's a very strange world where, South Korea, China, and Argentina are linked together, right? So we are much more surgical when we do this kind of analysis about what are the countries that are benefiting from the supply changes, what are countries that are benefiting from some of the changes in energy prices, and how do those fit into the portfolio. But the net of it, as you point out, is that the broad geographical diversification of our clients is much greater now than it was a decade ago. And that is actually, I think, going to be better for returns and certainly better for risks.
I know you've launched a decarbonisation fund, I think last summer. I think speaking to some of your folk in distribution, that's done really well. There's been a lot of interest in it, certainly. But yeah, there's been talk about, of a rewiring of the economy, and you, as you said, there post-COVID and with war and geopolitics and so on. Just be interesting to get your view on that, on how you're responding to these changes, that are to do with sustainability, that are to do with renewables, that are to do with all these sort of transition, these sort of big wheels that are turning at the moment. I've mentioned one product, but in bigger terms.
No, I'm really glad you've brought that up, Will, because I think it is important, and we've in fact just published a big piece on energy transition, because I think that we felt that the whole conversation 2 years ago was very lacked a lot of nuance. There was kind of, good technologies and bad technologies, and there was bad things that were happening in the brown space and good things that were happening in the green space. And not a lot of sense of, this is going to be a long, difficult journey to decarbonization. And there are fundamental trade-offs between growth, price, and climate that are going to need to be made in all of this. And we actually think that conversation's moved forward a lot. We would say that there's more, we call it ESG with integrity, but much more of a fact-based knowledge now about how this needs to be built into portfolios than there was a couple of years ago, where I think there was a lot of hand-waving, but maybe not as much substance. And I think we've got back to substance, which I think we really believe in the way that we manage money, and we have deeply embedded in our investment philosophy and in our processes, the notion that as a fiduciary, ESG risks are really, really important, and sustainability is important beyond that to certain types of clients, particularly in Europe.
Yeah. Some asset managers hold themselves out as specialists or are known to be specialists in sustainability, maybe from the day they began, the way they're founded. They're not as big as you. But do you feel like you've been doing this long enough, deeply enough to be ranked alongside them?
I think that we have, and I think particularly because we've been managing money in Europe for a very long time. I think that unlike a lot of other American managers, we do feel that we have kind of our roots maybe more deeply in that. At the end of the day, though, we are very acknowledge that this is our clients' money, not ours. And so I always find it a bit strange when people hold themselves out as if it's their decision. We're advisors. We manage our money as our clients would like to. Our obligation is to provide them the strategies, the tools, the ability to measure that so that they can express their own values, whether or not that's ESG or actually other social factors, in the way that they want. And so being a fiduciary does mean that it's your client's decision, and you manage money the way that they want to have their money managed.